Alright folks, how's it going? Let's start off with the performance, shall we? I've had a little bit of a comeback at 3.86% this week. But as you can see, I'm still lagging all of my comparators. No, actually, no, I'm not. The Life Strategy 60 is now performed worse than me since the 6th of October. Obviously, still a long way to go to ever catch up. There's the disclaimer. And so let's have a look where that performance came from, shall we? Basically, it's just kind of a comeback for the UK ones, I think, from what I remember. Mind you, I don't know, just everything really. FSIT's 4.62%. Murray International, yeah, just everything's done really well. Yeah, particularly the two banks. So I'm not sure what that's all about, to be honest. Oh yeah, it's a bit counterintuitive, isn't it? Really, inflation was lower than expected in the UK. But the banks were up by 10-12% each. But I always thought that higher interest rates were better for banks than lower interest rates, because obviously lower inflation means a better chance of interest rates going lower, which I thought was bad for banks. But I guess it gets offset by the fact that, I don't know, the economy would be in better shape. I don't know, because you've got to balance the profit they make on the loans compared with the probability of some loans not getting repaid, haven't you? It's like a balancing act. So sometimes higher interest rates are good, sometimes lower interest rates. I guess it's just whatever happens, and we see how well the banks do, I suppose. But for the first time, they're both. I think, if I'm not quite sure, but I think when I last mentioned this, Barclays hadn't reached a positive profit, I don't think. But yeah, now they're both in profit. That Barclays yield at 2.85% there is looking pretty low to me. And I'm just wondering if at some point, I don't know, maybe I should switch it to a higher yielding bank, maybe switch a bit into NatWest. I do have this thing that I was monitoring. So it's basically selling £4,000 worth of both banks, putting half of it into Phoenix Group, which is like a pension asset manager, I suppose. Yeah, I was going to put half of it into that and then half of it into SEHD, and that's doing a 50% pessimistic look at the Phoenix Group. That is, so that's 27 quid extra income, accounting for a 50% cut in Phoenix Group, because as you can see, it's got a ridiculously high yield of 10.52%. At one point I was looking at Legal in General, but the boat's somewhat been missed on that because the yield has come down to 8.82% now. But yeah, I don't know, I might, look, as things stand at the moment, I could easily just trim Barclays without trimming NatWest, and I can put some into SEHD, and that would be an increase in the yield, which is a bit strange. I'm used to these banks being really high, like value stocks, where other things are higher yield, lower yielding than them, but Barclays has got such a low yield at the moment. But maybe that's the worst possible time to sell it. Maybe that is a sign of the market saying things are going to go well for it in the future, and it should not be sold. So anyway, we'll see what happens. At some point, I won't be surprised if I got itchy feet on that front. And the Fundsmith Holdings, Novo Nordisk, is doing really badly. It's come right down from its highs. It used to be the number one in the portfolio, in the Fundsmith-ish section of the portfolio, but it's just going down and down and down. LVMH has continued its comeback. I believe that was up about 8% or something yesterday or the day before. Anyway, there's the full detail if anyone wants to look. And for the dividends, £128.80 for the week. And the big ones were Gore Street Energy and Assura, and then a few little ones from Fundsmith and SEHD. I'm not quite sure why I got 4 separate notifications. Obviously there's 2 different accounts for Gore Street Energy, but for each account I got 2 separate notifications for the dividend. Not quite sure what that's all about. Yeah, so you might remember, long-time viewers might remember, it looks like 10 months ago I made this video where I went through.
Let's read this disclaimer.
It's where I went through like a standard approach to retirement investing, and I kind of looked at how badly I've done compared to this kind of standard approach of rebalancing a 75% equities, 25% bond portfolio, and the video just shows how badly I've done. There was extra detail in here which I haven't got anymore because I lost my computer after this, and I can't be bothered going back in and fixing it. But obviously the calendar year has now gone around, and we've got another year's update here. So the what we've got here is an equity fund, a bond fund, and a money market fund. There's details of the three funds there. So now we've got the information. I had to wait for the money market fund's information, but that made 5.21% in the calendar year. So it's just to the 1st of January 2025. And we can see here that the portfolio's three funds did that amount. This sheet here doesn't use any of the money market fund. This is just doing a straight up 25% bonds, 25% equities. And we can see that we also had a RPI for the year of 3.86%. And what this does is it's doing RPI from October to October. You can see there which cells are being used. It's the change of the average of those months compared to the year before. And that's because in this like hypothetical plan, you don't have all of the information. So if you decide what to pay yourself at the end of December, you don't have the information for November and December yet. So but that's why I'm using that data. And we can see here for this year, it's 3.86%. So that's why we've input 3.86%. So in this plan, I would have been paying myself 17,626, and that would have been a withdrawal rate of 3.77%. So we can see here that in this scenario, because of the high inflation, even though the markets have done pretty well, we're still at a higher withdrawal rate on the 1st of January 25 than we were on the 1st of January 2019, because that was 3.4%. So yeah, at the moment, I mean, it's making progress, this method, but it's still getting back to the withdrawal rate that it started at. But it's still pretty good. This would have obviously I'd be way better off at the moment. I think in the previous video I estimated that I'd be about, it says there, doesn't it, 87 grand better off if I'd used this method, because in this video I also reinvested money that I hadn't spent, because that's what I've done in real life, isn't it? You've seen me in the unitisation spreadsheet add cash to the portfolio when I realised I've got excess cash. Six grand there, 1,300 there, 3 grand there, took 4 grand out there. But yeah, so I basically replicated all that in the video previously, and I was about 87 grand up. But yeah, I think obviously the same thing would have happened this year if I'd updated the spreadsheet. But yeah, the value of the portfolio, even if I'd spent this higher amount, the value of the portfolio now would be, actually no, you have to take it out first, 450 grand compared to the 395 grand that I've currently got. Although actually on the 1st of January it would have been lower, wouldn't it? So my portfolio was, on the 1st of January, well, 31st of December was 382 grand. But this one would have been 450. So we can see here, really do take note of my disclaimers at the beginning of each video. I'd have been way better off. Plus, the way these numbers have been done, I'd have spent more money as well. So my cash balances that are outside of the portfolio would be much higher. Because here, these amounts here are way higher than I've actually spent. At some point I should get in this spreadsheet and try and get those numbers correct like I had in the video. Or I've actually got the SSD drive from my old laptop. It's in my bag, but I don't know how to read it, and I can't be bothered buying something while I'm abroad. I figured I'd try and see if I can recover all that data when I get home one time. Who knows? Yeah, so that's the update on how things go. But yeah, just as an illustration, though, this shows how the system works. It's just a simple rebalancing thing. So because it's rebalancing, what we're doing is we've had a good year for stocks compared to bonds. So equities went up 17.19%, bonds only went up by 2.19%. So because of that, we rebalance back, and that means we're selling a high percentage of the equity portfolio, 6.94%, and we're actually purchasing bonds, 7.18%, which is $7,500 into the bonds. So by doing that, and then obviously we can recall back to times where we sold a very small, a smaller percentage of equities here, because they did worse than bonds marginally, and we sold 7% of bonds. But overall it's still 4%. Yeah, so here we go. Yeah, no, it's a good year for illustrative purposes. It shows here that when equities do badly, the system has you selling a low proportion of them. It's only 1.55%. So in a year where equities went down by almost 10%, you sell less of them, and you sell a lot more of the bonds, which didn't do too badly. And then obviously in years like this, most years will be like this because equities tend to do better than bonds over the long term. You're selling a lot more equities and putting them into the bonds. And then if we look at this example, it's the same example, but we're actually giving ourselves 10% in money market funds as well. And we can see that obviously this year has done better because the money market fund did better than the bond fund. So that 10% in money markets has served us well this year. And the 10% that's not in bonds, that is in the other one, is a lower proportion, so it's done better. We can see here that in this scenario where we have 10% in money market, it's only 3.72% overall compared to 3.77%. This is still adding in, by the way, the SIP bonus and the LISA bonus. So it's not reinvesting excess cash, but it is adding the SIP bonus and the LISA bonus. But what we should do is we should work out what the actual return was for this overall portfolio. So it's that amount minus the SIP bonus, because obviously that's not a return, that's kind of like well, it's exactly what it says, it's a bonus, isn't it? Right, so that's the value if we take away the bonus, and this is the value at the beginning of the year, so we divide it by that. That's the value on the 1st of January 24, divide it by that. Oh yeah, we need to take away 1. So that is the performance of this portfolio, 13.44%. What was my performance then? This is the thing, I don't track it in calendar years, you see. I track it on these random 6th of Octobers. So what do we do then? We do, I guess the closest we can get to is the 31st of December. I mean, it's the same anyway because the markets are closed on the 1st anyway, so it's going to be the same. Okay, and I think it's another 9.47% for me. So yeah, yet again I've done worse than a standard approach. It's yeah, I don't know how much longer this is going to go on for before I break. But every stat I look at is just terrible for me. All right, there we go. That's depressing, isn't it? Anything else to cover on this video? Oh yeah, I pondered more. I think last week I mentioned possibly selling a bit of City of London and putting it into Hint. I haven't pulled the trigger on that, but I was also looking at, I don't know, it just seems, the way I see it, these investment trusts, they're kind of pretty standard. There's not much between them. I have no reason to think City of London's manager will do any better than any other investment, UK equity investment trust that focuses in on income. I have no reason to think that this one will do any better than another one. So so the fact that it's not on a discount, it's about at par, it's about trading at roughly NAV. It kind of gets me thinking. So I was thinking to myself, is there any other alternatives? I've mentioned looking at JP Morgan Clever House, is it? I think I've mentioned looking at that one before, and I decided against it because it didn't have good dividend cover, and I think the debt profile wasn't as good. And I've had another look at it here on the AIC's website, as you can see. And there was another one that tempted me. There was, well, if we just sort by the premium and discount, Murray Income has a pretty decent record, and it's according to the AIC's website, it's at 11.41% discount to NAV. Yeah, so it's underperformed City of London, but probably most of it is just in the last year because City of London's done 13.18, this has done 2.14. But yeah, so I was pondering it because it's it is slightly a lower yield, but not far off. It's the yield is close, but to me the fact that the yield is close, but there's an 11% discount says to me that the underlying portfolio should have more growth potential, shouldn't it? Because the underlying yield of the portfolio is probably lower than City of London's, but because of the discount to NAV, you get it at a discount, so its yields roughly the same. But yeah, I did have a quick look at it, and the only thing that puts me off, it's the debt. It is all City of London's is all into like 2040s is when the debt starts getting maturing. But Murray Income's is all like 2027, 2029, and the dividend cover, as it stands, the dividend cover it's not that bad, but from memory, I think it's not covered. It's not. That's not a big deal actually. 97%. It's not so bad, but City of London is a percent or two higher. Yeah, so I did ponder it for a while, but I don't think I'm going to change it. I think I'll just stick with City of London. I mean, there was this whole other big move that I've been pondering for a while, but I've never mentioned. I can't remember when I started pondering this move, but there's also this. It's run by the co-manager or the deputy manager of City of London, but there is Henderson High Income. I don't think I've got a link to it. I think it's HHI. Henderson High Income. It has a decent chunk of bonds in there as well. But as you can see, it's a much higher dividend yield, run by the deputy manager of City of London. To me, it seems just like City of London with a big chunk of bonds and slightly less of a growth focus, more of a yielding today focus rather than future yield. But yeah, it's got a much higher yield. And so because of that, we would expect, it's still got dividend cover though, but because of that, we get less growth in the dividend. I've noticed Hargreaves Lansdown has a lot of messed up dividend pages at the moment, so this isn't how it should be at all. But yeah, so the dividend growth will be slower than City of London. But what I was thinking was it could get me into, instead of having something that grows at like 4% dividend per year, I could maybe have 60% of HHI, which would grow maybe at 2%, and then put it into a growthier like Global Trust. It will get me out of the UK, but keep the yield roughly the same. So here I've got modelled is putting it into Bankers, which is a global trust, which is run by Henderson International. Janice Henderson. So it's still in the same fund management group, but it's just it gets me less UK. But I mean, who knows, that could be the worst possible time to get out of UK. But I just thought I'd let you know this is something I've been pondering. Here's the same ponderment with Alliance Witten, but Alliance Witten. Well, sorry, if we look at Bankers, this is why I'm looking at Bankers, because it's got. I don't think I've got a link to it, have I? Let me find it here. See, that's another one with a discount of 9.29%. So yeah, I'm thinking maybe a few grand into Henderson International, 60% of the remainder into Henderson High Income to keep the dividend, and then the 40% of the remainder into Bankers, which is a lower yield one, but will grow its dividend a lot faster, and it gets me out of UK stuff. It's just another one of those things that I have on the back burner thinking about that might never happen. Okay, so I guess I'll leave it there then. All right, I'll see you next time then. Bye. Bye.